Welcome to our latest video where we're diving into another super important decision for CRNAs, specifically those working as independent contractors, aka 1099, aka locum work. So today we're going to be exploring a big question. Should you set up your 1099 income under an LLC to be taxed as a sole proprietor or to be taxed as an S-Corporation? This is really more than just a tax question. It's about steering your financial future in the right direction. So, let's get into it. So before we jump into real life scenarios, let's break down what these two structures actually mean. Now, assuming your LLC is set up already, this is basically a tax election underneath your LLC. As a sole proprietor, your business income and your expenses just fold into your personal tax returns. It's straightforward, but you got to watch out. This simplicity of that can cost you a lot more in essentially higher self-employment taxes. Why is this? Because you're covering both the employer and the employee portions of Social Security and Medicare taxes. Under W-2 income, on the other hand, your hospital is going to usually cover half of that. Now, on the other hand, that S-Corp election might lower your tax bill. You're going to need to pay yourself a salary, which is going to be subject to both sides of that self-employment taxes. And the rest of the business income essentially comes to you as dividends, and those dividends skip the self-employment tax. But, and it's a big but, this route, going the S-Corp route, brings a lot more complexity like handling payroll and meeting a bunch of other compliance needs. Issuing stock, setting up an accountable plan for reimbursement, and a bunch of other potential hoops that you're going to have to jump through. So the real question, is an S-Corp election worthwhile? Let's put this into perspective with two CRNAs. We have Esthesia and Nora Nephrine. First off, can I get some love for coming up with those names? All right, so Ann's making 275 grand. She puts 23,000 into her retirement and has 20 grand in business expenses. As a sole proprietor, let's run through how her tax calculations are going to work. So you can see in the income section on the right-hand side, she has 255,000 in net business income after taking off that 20 grand in expenses. She's looking at about $28,000 in self-employment taxes, of which she gets to deduct half of that. Then she puts 23 grand into her retirement plan. Dropping down to deductions, for simplicity's sake, we assume that she takes the standard deduction. For this year, it's $14,600. Then she gets her qualified business income deduction, or QBI deduction. Now, this is a newer deduction in the last few years. You know, when the Tax Cuts and Jobs Act came out in 2017, there was a major tax cut for corporations. So, Trump wanted to also provide a tax cut for small businesses too. So, what they did is they came up with this QBI deduction. Now the calculation admittedly is super convoluted for this, so I'm not going to cover it in this video, but it's vital to look at when you're making this comparison of S-Corp to sole prop. Now moving on to Ann's tax due, we can see that between federal and self-employment taxes, her total tax bill is going to come out to about $64,000. Switching to an S-Corp, you effectively wear two hats, again, and act as both the employee and the employer, whereby Ann's going to need to pay herself a salary. Now, what qualifies as a reasonable salary, again, is for another video. It's highly individualized, but just for today's video, let's say Ann tells her accountant she wants to pay herself a salary of $100,000. So she pays herself that $100K, and she still contributes the 23 grand to her retirement as an employee, which reduces those S-Corp wages to 77 grand. And her remaining income of roughly 147 at the top left here is effectively a dividend. And this is where the potentially appealing part of making this election exists. Only that $100,000 salary is subject to those payroll taxes, rather than all of it on the sole proprietor side. So as you can see here, her AGI, her taxable income, and her federal tax due are higher on the S-Corp side. But we need to add back in those payroll taxes and other administrative expenses on the bottom. I'm going to ballpark that at about $2,000. You've got bookkeeping and a whole other tax return to file, along with payroll. But even after tacking those additional expenses and costs back in, you can see here that there's roughly a $4,600 savings overall between the S-Corp and the Sole Prop. So what's the catch? You've got more administrative tasks and expenses, potential extra state-specific taxes, and because you aren't paying as much in payroll taxes, your future Social Security benefit down the road potentially is going to be lower as well. Now let's meet our grinder and super saver. She earns a little bit more. She makes $325,000, and Nora's all about maxing out her retirement contributions. Smart move, as it's going to lower her tax liability. Now, as a sole proprietor, she can stash away a hefty pre-tax amount, up to $69,000 into a solo 401k in 2024. But in an S-Corp setup, her retirement contributions are going to be capped by her salary, leading to more taxable income and higher taxes. She puts in the max of $23,000 as an employee, but as an employer, she is limited to 25% as a profit-sharing contribution on her salary. So she puts in that extra $25K. I realize that I'm going over this fast because attention spans are short here on social media, but basically this amounts to $48,000 in total pre-tax deferrals on the S-Corp side compared to the $69,000 that she can put in as a sole proprietor. Now here's the big rub, and what makes Nora's situation much different than Ann's. When earning more, whether you're single or especially if you're married and your spouse has income as well, is that it starts to phase you out of the QBI deduction, as you can see on the screen here. Also, the S-Corp salary, again, reduces how much Nora could pack away into her retirement plan. On the S-Corp side, she's only able to put away $48,000 compared to $69,000 on the Sole Prop side. All in all, if jumping to the bottom, you can see that in this scenario, the S-Corp actually results in more taxes and expenses than the Sole Prop. So I show it to you this way to reflect that there are some cases where the S-Corp just doesn't make sense. Nora's case really highlights how proactive planning plays into choosing your business structure. And this requires, and this goes without saying, obviously very super personalized advice to your own tax picture and your income expectations, as well as your goals. So here's the deal. Your situation is very unique to say the least. Please don't just copy what your colleague does over, break room talk. You're going to need to consider your income, your expenses, as well as your long-term goals. And remember that tax laws are complex and they're ever-changing. It's worth getting advice from a tax pro, especially one who knows the ins and outs of 1099 CRNA work. And also, stay flexible. As your career evolves, so too should your tax strategy. Stay informed and be ready to adapt. So, wrapping up here, choosing between a sole prop and an S-Corp for your 1099 income, it isn't just a financial decision. It's all about balancing simplicity with potential savings. Think about what works for your lifestyle, your financial goals, and how much administrative work that you're willing to actually take on. So with that said, that's all I got for today. If you found this video helpful, please give us a like, share it with your fellow CRNAs, and don't forget to subscribe for more CRNA related insights. Thank you for watching, and I'll see you in the next video. Take care. Once again, I'm Ben Barnhart, and I'm the founder of On Point CRNA and Barnhart Wealth Management. If you're interested in learning how we help our clients across the country with their money, head over to www.onpointcrna.com.